When you hear the name Warren Buffett, what comes to mind? For most of us, it's unimaginable wealth, a kind of financial magic that seems completely out of reach. His methods feel like they're whispered about in corporate boardrooms, not discussed in our living rooms. They seem complex, meant for billionaires, not for the rest of us. And let's be honest, most people who try to invest get completely lost. They get overwhelmed by blinking charts that look like a cockpit control panel. They chase risky hot stocks that are trending on social media, and more often than not, they lose money. They walk away convinced that investing just isn't for them. But what if that's all wrong? What if Warren Buffett's most powerful advice for beginners is actually shockingly simple? In this video, we're pulling back the curtain. We're going to demystify his core principles and give you a simple, clear roadmap. This isn't about getting rich overnight. It's about turning you from an anxious, confused novice into a confident, disciplined, long-term investor. Section 1. The foundation. It all starts with a mindset shift. Before we get into any specific strategies, we have to start where Buffett starts, with a total shift in how you think. This is the foundation of everything he's built, and it's this. Stop thinking like a stock trader. Start thinking like a business owner. That might sound like a small distinction, but it changes everything. A stock isn't just a blip on a screen you hope goes up. It's not a lottery ticket. It is a tiny piece of a real, living, breathing business. When you buy a share, you become a part owner. You own a tiny fraction of their factories, their brand, their patents, and most importantly, their future profits. Think of it this way. If someone offered to sell you a small slice of a local coffee shop, what would you do? You wouldn't just glance at yesterday's price. You'd go visit the shop. You'd try the coffee. You'd see if it's busy. You'd ask about their rent, their suppliers, and their competition. You'd want to understand the business inside and out before putting your money down. This is exactly how Buffett sees the stock market. He's not gambling on short-term price swings. He's investing in businesses he believes in for the long haul. This mindset instantly cuts through 99% of the noise and forces you to ask better questions. Instead of, will this stock pop next week? You start asking, is this a good business? Do I get how it makes money? Will people still be buying its stuff in 10, 20, or even 50 years? This leads right into one of his most famous ideas, the circle of competence. Buffett once wrote, you only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. This is a lesson in knowing what you don't know. Buffett is famous for avoiding entire industries he doesn't understand. He famously passed on the tech boom of the late 90s because he admitted you'd really get their business models. He said he had no clue where Microsoft would be in 20 years, but he was pretty darn sure people would still be chewing Wrigley's gum. For a beginner, this is the most liberating advice there is. You don't have to be an expert on biotech or complex software. Start with what you already know. Do you work in retail? You probably have a much better gut feeling for which brands have staying power than some Wall Street analyst. Your life and your career have already given you a starting point. The goal isn't to have the biggest circle of competence, it's to know exactly where your circle ends and to stay inside it. This single mental shift protects you from the number one reason investors fail, wandering into the unknown and making unforced errors. Section 2. The unbeatable advantage. The quest for an economic moat. Once you've got the business owner mindset and you know your circle of competence. The next job is to find truly great companies. Buffett uses a fantastic analogy for this. He pictures a great business as a strong castle, and the most important feature of that castle is the moat, protecting it. Just like a real moat protected a medieval castle from invaders, a great business has a durable competitive advantage, an economic moat that protects it from competitors. This moat is what allows a company to stay profitable and fight off rivals year after year. It's the secret sauce. So what do these moats look like in the real world? They usually come in a few flavors. First, there's brand power. This is a classic Buffett favorite. Think about Coca-Cola. For over 100 years, that company has built an insanely powerful brand in our minds. There are countless other brown, sugary drinks out there. Some might even win in a blind taste test, but they aren't Coke. That brand recognition lets Coca-Cola charge a little bit more and inspires a loyalty that's nearly impossible for a competitor to copy. A more recent example from Buffett's own portfolio is Apple. Apple's moat is a mix of things. Its brand, sure, but also incredibly high switching costs. Once you're in the Apple ecosystem with your iPhone, MacBook, and Apple Watch all synced up, the thought of switching to something else is a huge pain. This keeps customers locked in and gives Apple incredible pricing power. A second type of moat is a cost advantage. Some companies, just because of their size and efficiency, can make their products or offer their services way cheaper than anyone else. Think of a company like Walmart. Its massive global supply chain allows it to squeeze better prices from suppliers and pass those savings to us, making it incredibly tough for smaller stores to compete on price. A third moat is the network effect. This is when a service gets more valuable, the more people use it. A perfect example is Visa. The more stores that accept Visa, the more useful it is for you and me. And the more of us that carry Visa cards, the more essential it is for every store to accept it. It's a powerful feedback loop that's very hard for a newcomer to break into. Finally, some moats are just high barriers to entry. It is wildly expensive and complicated to build a new railroad, a new power grid, or a new airport. These industries have natural moats that protect the companies already in place. As a new investor, learning to spot these moats is one of the most vital skills you can build. It forces you to look past the latest earnings report and think about whether a business can truly last. Ask yourself, what protects this company from competition? Why can't someone else just do the same thing, but cheaper? If you can't find a good answer, you probably haven't found a castle with a moat. Section 3. The billionaire's secret weapon. Demanding a margin of safety. Okay, so let's say you've done the work. You're thinking like an owner. UVA found a wonderful business, a strong castle with a wide moat, and it's just right in your circle of competence. So you just rush in and buy it. Right. Wrong. This is where we bring in what Buffett calls a cornerstone of investing. A lesson he learned from his mentor, Benjamin Graham. It's called the margin of safety. The idea is beautiful in its simplicity. Never overpay, no matter how great the business is. In fact, you should insist on buying it for way less than you think it's actually worth. That gap between the business's true, underlying value, its intrinsic value, and the price you pay is your margin of safety. Buffett explains it with a great analogy. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. That extra 20,000 pounds of capacity is your margin of safety. It's your cushion. It protects you if your math was a little off, or if an unexpected storm hits. In investing, that cushion protects you from all the things you can't predict. A new competitor, a recession, or maybe you just made a mistake in your analysis. A margin of safety means that even if things don't go perfectly, you haven't set yourself up for a disaster. Remember Buffett's 2 famous rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. The margin of safety is how you follow those rules. So how do you do this? First, you have to estimate what the business is intrinsically worth. This is more of an art than a science. Professionals use complex financial models, but you can think about it more simply. Imagine you found an envelope that you know for a fact has a crisp $100 bill inside. What would you pay for it? You'd happily pay $50. You'd probably pay $70 or $80. But would you pay $101? Of course not. Value investing is the art of figuring out what's in the envelope and then waiting patiently until someone offers to sell it to you for $70. That $30 discount is your margin of safety. The key here is patience. The stock market is an emotional beast. Sometimes, investors get euphoric and will happily pay $120 for that $100 envelope. That's when a buffet-style investor sits back and does nothing. Other times, investors get scared and they'll desperately sell that same envelope for just $60. That is your moment. That's when you get a wonderful business at a wonderful price. This takes discipline. It means you have to ignore the hype and focus on just 2 things: what a business is worth and what price you're being asked to pay. By demanding a significant margin of safety, you build a powerful defense against your own mistakes and the market's mood swings. Section 4. The 2 most powerful words in investing. Be fearful. If one single quote captures Warren Buffett's entire psychological game plan, it's this. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. This is probably the hardest advice for any human to follow, because it goes against our very nature. We're wired to find safety in the herd. When everyone around us is panicking, our gut screams at us to panic, too. When everyone is giddy and buying, we get a serious case of FOMO, a fear of missing out. Buffett's entire career has been about mastering these instincts. He understands that in the short term, the market isn't a logical machine that weighs a business's value. It's a popularity contest, driven by emotion. And those emotions swing back and forth, from wild optimism to deep despair. So what does being greedy when others are fearful really mean? It means seeing a market crash not as a disaster, but as a sale. In late 2008, during the darkest days of the financial crisis, when the entire global economy seemed on the verge of collapse, Buffett wrote an article for the New York Times. He calmly said that while headlines were terrifying, he was buying American stocks. He knew that fear had driven the prices of excellent companies to bargain basement levels. Buying during that moment of maximum fear was the ultimate greedy move. On the flip side, being fearful when others are greedy means being extremely careful when the market feels too good to be true. During the dot-com bubble of the late 90s, people were quitting their jobs to trade stocks of companies with no profits. Greed was everywhere. Buffett, in contrast, was fearful. He was called a dinosaur, out of touch, but he stuck to his guns, refusing to buy businesses he didn't understand at prices that made no sense. When the bubble burst, his discipline paid off, while the hype chasers lost everything. So how can you actually do this? First, stop checking your portfolio every single day. It only magnifies the market's noise and tempts you to act when you should be patient. Second, make a plan before the panic starts. Decide now what you'll do in the next market downturn. Will you keep investing on schedule? Will you have extra cash ready to buy more? A plan helps you stay rational when your brain is telling you to sell. Third, focus on the business, not the stock price. Is the company still selling its products? Is its moat still strong? If the answers are yes, then a 30% drop in its stock price is an opportunity, not a crisis. Emotional discipline isn't a talent. It's a skill you build. It's the final piece of the puzzle that separates the pros from the amateurs. By learning to detach from the market's mood swings, you can turn its greatest weakness emotion into your greatest strength. All right, we've gone through some deep concepts. Here, thinking like an owner, finding moats, demanding a margin of safety, and keeping your cool. If these ideas are starting to click and you're feeling a bit more confident already, do me a quick favor and hit that subscribe button. We're about to get to what might be the single most important and practical piece of advice Buffett has for most of the people watching this. Trust me, you don't want to miss it. Section 5. The Do-Nothing Strategy, Buffett's ultimate advice for you ****. So far, we've been talking about how Warren Buffett himself analyzes and picks stocks. It's a masterclass in business, finance, and psychology. But here's the big twist, and for many people, it is a huge surprise. Warren Buffett does not think that most people should try to invest this way. He's been crystal clear about this for decades. He knows that most of us don't have the time, the background, or the emotional stomach to successfully pick individual stocks and beat the market. In fact, he loves to point out that even the highly paid professionals on Wall Street consistently fail to do it. So what's his number one recommendation for the average person trying to build wealth? It's breathtakingly simple. In my view, for most people, the best thing to do is own the S&P 500 index fund. Let that sink in for a second. The greatest stock picker of all time says that most people shouldn't pick stocks at all. Instead, he recommends a passive strategy. Buy one low-cost fund that owns the 500 biggest companies in the US, and then the most important part, do nothing. Just keep buying it, consistently, over time. Why is he such a huge fan of this? First, it gives you instant diversification. With one purchase of an S&P 500 index fund, you instantly own a small piece of 500 giants, from tech to healthcare to banking. You're not betting on one horse, you're betting on the entire American economy to succeed over time. Second, the costs are incredibly low. Actively managed funds charge high fees for their expert stock picking, which, as Buffett proved, rarely works out. Index funds have tiny fees because they're on autopilot. Over your lifetime, that difference in fees can literally add up to hundreds of thousands of dollars more in your pocket. Third, you can't argue with the results. Over the long run, the S&P 500 has delivered powerful returns. Buffett famously made a $1 million bet that a simple S&P 500 index fund would crush a portfolio of hedge funds over 10 years. He won the bet easily, proving that for most people, trying to be clever is a loser's game. The smart move is to just buy the whole haystack instead of searching for the one magic needle. Buffett believes in this so strongly that he's putting his own family's money on it. In his will, he has directed that 90% of the money left for his wife be put in a low-cost S&P 500 index fund. If this strategy is good enough for the Buffett family, it's definitely good enough for us. For a beginner, the steps are simple. ***, choose a low-cost S&P 500 index fund. ***, providers like Vanguard, Fidelity, and Schwab all have great, cheap options. ***, automate your investments. ***, set up a recurring transfer from your bank account. This is called dollar cost averaging, and it takes emotion out of the game. Stay the course. This is the hardest part. There will be recessions and terrifying headlines. Your job is to ignore the noise and stick with the plan. Patient investors have always been rewarded. This strategy isn't sexy. It won't give you a crazy stock story to tell at a party. But it is a proven, reliable, and powerful way to build real wealth over time. It is Buffett's ultimate gift to the beginner investor. Section 6. Your simple roadmap. From novice to confident investor, we've covered a lot of ground, so let's boil it all down into a clear, actionable plan. This is your guide to applying Buffett's wisdom to the real-world problems that trip up new investors. ***, if you feel ... I'm totally overwhelmed by all the choices. Buffett's solution. ***, don't try to analyze everything. Either define your circle of competence in industries you truly understand or, even better, take his main advice and just buy a low-cost S&P 500 index fund. That one decision solves the problem of choice paralysis. Asterisk, if you feel I'm terrified of a market crash and losing my money, Buffett's solution. Asterisk, reframe how you see it. Only invest money you won't need for at least 5 to 10 years. Time is your best defense against volatility. Then, view a crash as a sale. Your regular, automated investments are now buying you more shares for the same amount of money. Be greedy when others are fearful. Asterisk, if you feel I don't have enough time or expertise for this. Buffett's solution. That's exactly why he recommends index funds. The strategy is designed for busy people. By automating your investments into an index fund, the time commitment drops to near zero. You're getting the growth of 500 great companies without having to be an expert yourself. Asterisk, if you feel I know I'll get emotional and sell at the worst possible time. Buffett's solution. Great. Acknowledging that is half the battle. Now, build a system to protect yourself from your own emotions. That system is automation. Setting up automatic, recurring investments forces you to be disciplined. It takes your feelings out of the driver's seat. Asterisk, if you feel I'm tempted to chase the hot new stock or crypto. Buffett's solution. Remind yourself of the difference between investing and gambling. Investing is owning a piece of a productive business for the long term. Speculating is just betting on a price. If you absolutely can't resist, quarantine the gamble. Put 95% of your money in a boring S&P 500 fund and allow yourself to play with the other 5%. This protects the core of your wealth from a risky bet. By following this roadmap, you're building a rational, resilient investment strategy. You're applying a time-tested philosophy that has created not just immense wealth, but financial peace of mind. The world of investing often seems designed to make you feel like you're not smart enough. It's full of jargon and a sense of urgency that pressures you into making bad decisions. But the enduring wisdom of Warren Buffett cuts right through all that noise. His message, when you boil it down, is about simplicity and patience. Think like you own the business, not like you're playing a game. Invest in wonderful companies you can understand, castles with moats, and buy them only when they're on sale. And most importantly, learn to control your own emotions. To be brave when others are panicking and careful when they're celebrating. And for most of us, the path is even simpler than that. Embrace the power of a simple S&P 500 index fund. Bet on the long-term success of business as a whole. Keep your costs low, invest consistently, and let compound interest work its magic for you over the decades. You don't need to be a genius. You don't need a PhD in finance. You need discipline, you need patience, and you need a sound framework for your decisions. The journey to becoming a confident investor doesn't start with a hot tip. It starts today, with the choice to adopt these principles and a promise to yourself to stay the course. The future you will be very glad you did.